students, in present video I am going to explain about fourth problem from partnership accounts topic. I am taking this problem from Telangana State Telugu Academy Inter Second Year Accountancy Textbook. But this video is useful to all commerce students who want to know about this topic. Let us see the question first. Sita and Geeta are partners sharing profits and losses in the ratio of 2:3. So Sita's share 2/5. How 5 came? 2 plus 3. Geeta's share 3/5. Their capital account showed a balance of 1 lakh rupees and 1,50,000 rupees respectively as on 1st April 2014. So this is opening date of the year. Therefore, these two capitals are known as opening capitals. So Sita invested 1 lakh rupees and Geeta invested 1,50,000 rupees in the business. During the year, Sita and Geeta withdrew 5,000 rupees and 7,000 rupees respectively for personal use. These are known as drawings. Sita's drawings 5,000, Geeta's drawings 7,000. Interest on capital to be provided at the rate of 8% per annum. Partners are bringing capitals now. On these capitals, firm has to pay 8% interest to partners. Interest on drawings amounted to 500 and 700 respectively. So partners are withdrawing some amounts for personal use now. On these amounts, partners have to pay interest to the firm. Interest on drawings. Profit for the year ended 31st March 2015 before making above adjustments amounted to 75,000 rupees. So this is called net profit. Profit and loss account answer net profit, that is given in the question only. And what he is asking us to prepare? Prepare profit and loss appropriation account, partners capital accounts under fluctuating capital method, fixed capital method. This is the question. Let us see the solution for this. In previous video also I explained, that video link I am giving in the description box. So in Inter first year, we prepared the final accounts of sole proprietorship business. Final accounts of sole proprietorship business contains trading account, profit and loss account and balance sheet. Now here we should know about final accounts of partnership business. First they prepare trading account, second profit and loss account, profit and loss appropriation account, partners capital accounts. To prepare partner capital accounts, two methods are there. First one, fixed capital method. Second one, fluctuating capital method. Finally, they prepare balance sheet. Here, balance sheet, profit and loss account, trading account. Already you have some idea about them. So, in this problem, he is concentrating on these two new points. Profit and loss appropriation account and the partners capital accounts. Under these two methods he is asking. In third problem, he asked partners capital accounts under fluctuating capital method. Here the new point is, under fixed capital method also we have to prepare partners capital accounts. So first we have to prepare profit and loss appropriation account. So profit and loss account and trading account, both are nominal accounts now. In the same manner, profit and loss appropriation account is also a nominal account. So nominal account rule, debit all expenses and losses, credit all incomes and gains. So expenses, losses, debit side we should show, credit side, incomes and gains. And the difference between profit and loss account and the profit and loss appropriation account is, in profit and loss account, debit side, we show business related expenses and losses. Credit side, business related incomes and gains. But in profit and loss appropriation account, debit side we have to show partners related expenses and losses. Credit side, partners related incomes and gains. With a simple example, I will explain this. Suppose partnership firm paid salary to accountant. Accountant is an employee, no? So to one employee we are paying salary. This is business related expenditure. In P&L account, debit side we should show this. Suppose in Sita and Geeta, say Sita is active partner, Geeta is sleeping partner. To Sita, firm is paying salary monthly. So this salary is an expenditure to the firm. But to whom we are paying that? To partner. So partner related expenditure now this is. Therefore salary to Sita appears on debit side of profit and loss appropriation account. We should not show that in profit and loss account. That is the basic difference between these two. And in trading account our answer is gross profit or gross loss. In profit and loss account our answer is net profit or net loss. In question already that net profit is available now. That is why we need not to prepare trading account and profit and loss account. Because profit and loss account answer is directly given in the question. By taking that we have to prepare profit and loss appropriation account. And this net profit we said we should take trading account gross profit comes on debit side. In P&L account credit side we take. Similarly net profit comes on debit side of P&L account. In P&L appropriation account credit side we should take. So credit side by net profit 75,000 rupees. Next, see the question from starting. Sita and Geeta are partners sharing profits and losses in the ratio of 2:3. Their capital account showed a balance of 1 lakh, 1,50,000 respectively as on 1st April 2014. Opening capital is not an expenditure, not an income. Therefore, opening capitals you need not to show in profit and loss appropriation account. Ignore. Next, during the year, Sita and Geeta withdrew 5,000, 7,000 respectively for personal use. Drawings also same. Not an expenditure, not an income. So don't show in P&L appropriation account. Continuation. Interest on capital to be provided at the rate of 8% per annum. Interest on capital. As per business entity concept, firm is separate, partners are separate. So when partners are bringing capital, we should assume that firm is taking loan from them. When you take loan, you have to pay the interest now. So interest on capital is an expenditure to the firm because firm is paying to partner. So partner related expenditure now means in appropriation account debit side we should show two interest on capital. First, Sita. She brought 1 lakh rupees capital. On that, at the rate of 8%, 8,000 is her interest on capital. Next, Geeta. She brought 1,50,000 rupees capital. On that 8%, 12,000 rupees. Next, interest on drawings amounted to 500 and 700 respectively. Interest on drawings means from the firm partners are taking money. So means firm is giving loan to them. On that partners have to pay interest to the firm now. In firm's books we are preparing this thing from firm's point of view. To the firm, interest on drawing is income. Partners related income means credit side we should show. By interest on drawings. Sita's interest on drawings. No need to calculate because direct amount is given now 500 rupees. In inner column you can write and you can add both, but I am writing in outer column only. Geeta 700 rupees. Continuation. Profit for the year ended 31st March 15 before making the above adjustments amounted to 75,000. We have taken that. Finally, he is asking to prepare these two. So everything is completed. Finally, we have to calculate the profit or loss. Credit side total is more than debit side total. In rough notes, credit side total first we should calculate. Credit total is 76,200. Debit total 20,000. So difference 56,200. Credit side we wrote incomes, debit side expenses. Income is more than expenditure. Means finally we got profit. This profit belongs to partners now. How they share that? In 2:3 ratio. By transferring this profit to partners capital accounts, we have to close this account. So debit side to Sita's capital account. Next to Geeta's capital account. Profit is 56,200. Sita share 2 is to 3 means 2 by 5 now, into 2 by 5. Geeta 56,200 into 3 by 5. 11,240 into 2. Here also 11,240, that into 3. So in total profit, Sita's share is 22,480. Geeta's share is 33,720. Now as a total, highest amount 76,200 you have to write on both sides. After P&L appropriation account, I am going to prepare capital accounts under fluctuating capital method. That is why this profit I am directly transferring to capital accounts. Next, I am going to prepare capital accounts under fixed capital method. No? In this case, instead of transferring to partners' capital accounts, you have to transfer this profit to partners' current accounts. So you may get one doubt. Means in examination 2 times you have to prepare this. Only this is new, no? Remaining all points are same. You need not to prepare for 2 times. So by transferring to capital accounts, we close this. Then under fluctuating capital method we are preparing. Then under fixed capital method again capital accounts only we prepare. So this is negligible. Okay. So under fixed capital method when you are preparing capital accounts, actually speaking to current accounts you have to transfer these 2 amounts. But in examination again you need not to prepare P&L appropriation account only for that small point. Some people do like this. To net profit they write Sita, Geeta. So they transfer like that. That is also okay. So P&L appropriation account is completed. Next come to partners capital accounts under fluctuating capital method. Capital accounts under fluctuating capital method. Particular Sita, Geeta, particular Sita, Geeta. Here actually speaking, Sita's capital account, Geeta's capital account separately we should prepare. But in one table only we are preparing to save the time. To prepare capital accounts, remember one point. So capital account is a representative personal account. Personal account rule, debit the receiver, credit the giver. So if partners are receiving any benefit from the firm, debit side we should write them. Same point in another manner also I will tell. From the firm, partners are receiving. If they retire, they have to return that money to the firm, no? So at the time of retirement, the amounts which partners should return to the firm, debit side we should write. Remember like this. Personal account rule, debit the receiver, credit the giver. So when partners are giving some money to us, credit side we should write. Same point in another manner. Partners are given to the firm. If they retire, firm should return that money to them, no? So at the time of retirement, the amounts which firm has to pay to partners, credit side we should write. Sita and Geeta are partners sharing profits and losses in the ratio of 2:3. Their capital account showed a balance of 1 lakh, 1,50,000 respectively. Capital is a liability. Liability shows a credit balance. Therefore, credit side we should write. These two are opening balances, no? So, by balance brought down, in Sita's column, 1 lakh rupees. In Geeta's column, 1,50,000 rupees. Otherwise, under this hint method also we will analyze. Partners brought capitals into the firm. Suppose they are retiring. Firm has to return these amounts to them, no? So at the time of retirement, firm has to return these 2 amounts to partners. That is why credit side we are writing this. Next, during the year, Sita and Geeta withdrew 5,000, 7,000 respectively for personal use. Drawings, no? So drawings means from the firm partners are taking. If they retire, they have to return that money to the firm, no? So at the time of retirement, drawings amounts partners should pay to the firm. Means debit side we should write them. To drawings account. Sita 5,000, Geeta's drawings 7,000. Continuation. Interest on capital to be provided at the rate of 8% per annum. Interest on capitals we have calculated here now. So interest on capital, who should pay to whom? Firm has to pay to partner now. So firm has to pay to partner at the time of retirement. Means interest on capital credit side we should take. Sita 8,000 rupees, Geeta 12,000 rupees. Continuation. Interest on drawings amounted to 500, 700 respectively. So from the firm, partners have taken drawings. On that, they have to pay interest to the firm now. At the time of retirement, partner should pay interest on drawings to the firm. So, debit side. To interest on drawings. Sita 500, Geeta 700. Profit for the year ended 31st March 15 before making above adjustments amounted to 75,000. Net profit only in appropriation account we should take, not in capital accounts. So everything is completed. Finally, we transferred profit to capital accounts now. These two amounts also we should take. Partners' profits these are. If they retire, firm should pay to them now. Means beside credit side. From which account you are taking these two amounts? From profit and loss appropriation account. Write down that. By profit and loss appropriation account. 22,480 for Sita, 33,720 for Geeta. Everything is completed. Finally, we have to balance capital accounts. Credit totals minus debit totals. Sita's credit column total is 1,30,480. Debit column total 5,500. Difference 1,24,980. So credit side total is more. Debit side total is less. Debit side we have to write this balance. To balance carried down 1,24,980. Two sides highest total 1,30,480. Credit side also same. Geeta, same no? Credit total is more than debit total. So debit side only this balance carried down we should write 1,88,020 rupees. Total, highest total 1,95,720. Credit side also same. Capital accounts under fluctuating capital method completed. Next come to capital accounts under fixed capital method. Under fixed capital method, we have to prepare current accounts and capital accounts of partners. So first current accounts under fixed capital method, everything is same. Only the new point is don't write opening capitals. So partners are bringing 1 lakh and 1,50,000 rupees capitals now. These capital amounts we should not show in current accounts. So remaining all adjustments as it is we have to write. Okay. So already I explained why they are coming on credit side and debit side. Same explanation. Then finally current accounts we have to balance. Sita credit side 30,480 minus debit total 5,500. So balance carried down 24,980. Debit side. Two sides highest total 30,480. Credit side also same. For Geeta also same. Debit is less. So debit side this balance carried down amount we should write 38,020 rupees. Two sides highest total 45,720. Here also same. So current accounts of partners completed. Next we have to prepare capital accounts of Sita and Geeta. See, these are the capital accounts of partners. Capital accounts under fixed capital method. Particular Sita Geeta, particular Sita Geeta. Here only one amount we are going to show. That is their capitals, opening capitals. In current account we have not written no. In capital accounts we have to show them. So capital is a liability, it shows a credit balance no. So credit side we should write. By balance brought down. Sita brought 1 lakh rupees capital. Geeta brought 1,50,000 rupees capital. Don't write any other adjustments. Therefore, closing balance also same no. So debit side to balance carried down. Same amount 1 lakh rupees 1,50,000 rupees. Totals also same. Credit side also same totals. Why this method is called fixed capital method? Now I think you understood. Opening capital and closing capital both are same. No fluctuations, no difference. Therefore, this method is called fixed capital method. So under this method, only capital information we show in capital accounts and other adjustments like interest on capital, interest on drawings, etc. we show in current accounts. When firms follow fixed capital method, suppose partners want to share the profit and losses in their capital ratio. In that case, opening and closing capital should be same. That is why they follow fixed capital method. And as I said earlier, so under fixed capital method, when you are preparing capital accounts, actually speaking, in P&L appropriation account for answers, what to write? To Sita's current account. To Geeta's current account. So these two amounts in current accounts credit side we should write. But again you need not to prepare P&L appropriation account only for these small amounts. So one P&L appropriation account is enough. Okay. So this is all about fourth problem from partnership accounts topic. Hope this video is helpful to you. Thank you.